This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Hi, in this lecture we're going to take a look at subleases. So it's the scenario where, let's say, person A or company A owns an asset, lets it to company B, and then company B lets it to company C. It could arise in all sorts of situations, but principally, again, we'll think about the context of something like land and buildings. It's a subject where you could end up very confused, and therefore, please make sure you stick to the basics. If you can explain the basics, that's all the examiner will be looking for. So, in my scenario, in the notes, I've said here that let's assume that A leases a building to B for 90 years. The life of the building is 100 years, effectively, so it's for virtually all of the life of the building. I'm not going to worry about the books of A. For the moment, I want to focus on B. When A leases the building to B, that's called the head lease. B then sublets the building to C for, again, a period of time, the sublease. Head lease at the top, sublease underneath. So how does B reflect these transactions in the accounts? Let's think about the head lease first. B is a lessee. So think of your normal lessee accounting. In almost all cases, you recognize a right of use asset and a lease liability in the balance sheet. The only exception would be if it was a lease of, say, less than a year or low value, which is not relevant here. In the P&L, the right of use asset would be depreciated and the liability would give rise to finance costs. So it would be the regular recording for the lease. So B would debit right of use asset and credit lease liability. Now, in our situation, we've said that B is now going to rent the building out to C. I've built in two scenarios. One is I'm renting it for 90 years and I sublet it for 90 years. The other one is I'm renting it for 90 years and I sublet it for 10 years. Remember that when we were talking about the head lease, then the role that B was playing, if you like, was B the lessee, the customer. But now the role changes because B is now passing on use of the asset to C. So it's almost as if B is wearing a different hat. So B has now got a new hat on. B is now the lessor. Think about lessor accounting. Either things are finance leases or operating leases. Long-term leases that we give as a lessor are finance leases. Short-term leases are operating leases. Then we just have to say, well, what's the accounting for these things? If you've got a finance lease, then remember that you don't show the physical asset in your books. What you would show is a lease receivable. So where you've got a finance lease, often something where probably the life is more than 3/4 of the life of the asset or whatever, then you show a lease receivable. So in those circumstances, if I am the lessor of a finance lease, what's going to happen? I need to show a lease receivable and finance income. Previously, in the balance sheet, I had a right of use asset. I don't need that anymore. The right of use asset is going to become a lease receivable. Now, it could be that there's a slight difference in value between the right of use asset and the lease receivable, which would end up in the profit and loss. But don't worry about that at the moment. Just sort out the basics, the big picture. The big picture is I do not need this right of use asset in my accounts. So we say goodbye and hello to the lease receivable. So what happens is that B will get rid of the right of use asset and set up a lease receivable in its place. Remember, you don't have to say debit, credit in the exam. You can say up and down. Perhaps recognize and de-recognize would be better phrases. So A rents to B and B rents to C. What's the outcome? The net outcome is that B will end up with a big lease liability in its accounts because it owes some money to A, and it'll end up with a big receivable in its accounts because actually it is owed money by C. It's purely, isn't it, a bit like a finance arrangement. If, however, B is subletting the building for a short period of time, it's an operating lease. So remember, when you think about a company that rents out cars, they rent them out for the weekend or whatever, or for a short time. They leave the car in the balance sheet, don't they? Like Avis or Hertz or whatever. They leave the car in the balance sheet and just recognize rental income. So I will leave the right of use asset in my accounts and again, just show rental income. So I know it's a complicated phrase, isn't it? But the right of use asset will not be de-recognized. Leave it alone. But what we will show is rental income coming in. There's quite a lot there. Keep it simple though. Keep it simple in your explanation and you'll be fine. They aren't going to give you hideous numbers. They're just looking for the clarity of a basic explanation. I'd recommend that you listen to this lecture again now, just to think it through a little bit more deeply. As I said, try not to worry about detailed numbers and exceptions. Keep to the basics to get the picture across to the examiner. Thank you.